Welcome to the Deep Dive. This is Talk Tickers, and we're here to skip the earnings call filler and get straight to what really matters.
And today we are doing a critical deep dive into DLH Holdings Corporation. Their Q4 for fiscal year 25 was, well, it was a really complicated one.
Complicated is a good word for it. This quarter was defined by, I think, a huge strategic contradiction.
Exactly. On one hand, you have these really punishing financial headlines, just tough numbers. But on the other, they scored some pivotal long-term financial wins.
So our mission for you, the listener, is to figure out if management's story holds up. They claim they're pivoting to high growth, high margin work. But can that story overcome the current headwinds?
Let's find out.
Okay, let's start with that core dilemma, because the market gave its answer right away, and it was a loud no.
Oh yeah, the stock closed down 3.41% on the day of the release, and the volume was up over 50%.
A lot of people were selling, and when you look at the top line, it's pretty easy to see why.
That tape doesn't lie, not in the short term. Revenue came in at $81.16 million.
Which was a big miss. Consensus was what, $83.50 million?
Right, so that translates to a very steep 15.8% decline year over year. Ouch.
And the bottom line was just as rough. GAAP, earnings per share, a loss of 6 cents.
Yeah, negative 6 cents. When the consensus was for a positive 2 cents, that's an 8-cent miss. That kind of contraction is a really tough pill for investors to swallow.
Especially in government services, right?
Yeah.
You expect stability.
You do. But this is where that divergence, that contradiction really starts to show. Because while revenue is terrible, they had one anchor to cling to. Cash generation. Despite all the top-line pain, the company generated $10.7 million in free cash flow in just one quarter.
And that FCF is really the only positive thing in those headline numbers. The market clearly focused on that 15.8% revenue drop. Cash flow just wasn't enough to calm them down.
Not at all. And to understand that fear, you have to dig into what actually caused that drop.
Okay, so let's do that. What broke?
Well, management was actually quite transparent here. They said it was largely transitional, pointing to very specific contract dynamics.
They put a number on it, right? Something like $11 million of that drop came from what they called contract dynamics.
Yep. Specifically, contract unbundling and conversions to small business set-asides.
Can you break that down for us? Because this is a really common pain point for firms like DLH.
Certainly. So the government often mandates that after a certain period, a contract has to be set aside for a small business. DLH, as a larger firm, might have won that contract originally.
But when it gets recompeted,
Fair out. The work automatically goes to a smaller, say, a minority-owned or veteran-owned firm. It's good policy for spreading opportunity, but it's guaranteed revenue loss for the big incumbents.
and DLH was pretty clear they weren't going to fight it. They knew the Head Start program transfer, for example, was coming.
Right. They didn't even protest the mandate. And we saw the same thing with the CMOP programs.
That's the Consolidated Mail Outpatient Pharmacy Program. Basically logistics for the VA.
Exactly. They transitioned one of those locations in Q4, another one since the year ended. They're still working at the other three while the VA figures out a new plan. So this is all planned shrinkage.
So the revenue decline, while it looks bad on paper, was mostly anticipated. It's the cost of these policy shifts. But what about margins? That environment must have taken a toll.
It did. Adjusted EBITDA came in at $6.6 million. That's an 8.1% margin, which is way down from 11.1% a year ago.
Lower revenue is the obvious cause there.
It is, but you have to give management credit for this next point. They explicitly chose not to slash their innovation budget.
That's a huge decision. They could have cut R&D to make the margin look a little better today.
But they didn't. They didn't slash and burn their future just for a slightly better quarterly number. To me, that signals a lot of confidence in where they're headed.
So they're taking the short-term pain for the long-term gain.
Absolutely. And they said they fully expect to get back to their normal historical levels for margins. They think scaling up some new activities and, crucially, winning more of that high-value tech work will get them there.
Okay, let's pivot to the one area where there was no ambiguity.
Yeah.
The balance sheet. They hammered this point home on the call.
This was their undisputed win for the quarter. They reduced debt by $10.7 million in Q4 alone.
Ending the year with, what, $131.6 million in total debt? That's a nearly 15% reduction year over year.
It is. But here's the real kicker. the key milestone. They have now made all mandatory term debt payments through September 30, 2026.
Wait, so they're a full year ahead of schedule?
A full year ahead. It's a massive operational win. And they guided that in fiscal 26. They plan to convert 50 to 55% of their EBITDA straight into more debt reduction. It's an incredibly aggressive deleveraging story.
Cash flow is impressive, no doubt.
Yeah.
But we have to talk about the counterweight. The thing that probably spooked investors just as much as the revenue miss. It's exactly your future pipeline. Backlog fell 25.5% year over year, down to $514.3 million.
And that's the signal of near-term weakness. It completely offsets the good news on the balance sheet because it suggests less guaranteed revenue is coming in the door.
So this is why management had to lean so hard on that strategic pivot narrative.
Precisely the bet. The old lower margin work is rolling off. The immediate backlog is shrinking. So they are making a huge bet that this new higher value technology work can fill that gap and fill it fast.
They're trying to become a tech, engineering, and research provider, not just a logistics and staffing firm.
It's a structural shift, and their focus areas show it: digital transformation, cybersecurity, systems engineering, science, R&D.
And to prove it's real, they kept talking about their proprietary tools from their innovation labs.
And this is where we need to pay attention. Proprietary IP is the only way you get premium margins in this sector. They mention tools like DLH Neura, DH Nexus Labs, but let's really focus on one, DLH Cyclone.
Okay, so tell us about Cyclone. What is it actually designed to do for a government client?
Think of it as an AI and machine learning powered data engine. The government, as you can imagine, is drowning in unstructured data.
Clinical records, satellite imagery, field reports, you name it.
Total chaos. Cyclone is built to ingest all of that messy data and process it to find actionable intelligence fast.
And the pitch isn't just that it's better, it's that it's cheaper and faster.
Exactly. It's supposed to be more efficient than the clunky legacy systems the government is using now. If you can walk into a DoD office and say, my tool can speed up your mission by 30%, you're going to win that contract.
And command a much higher margin for it. But to handle that kind of sensitive data, you need credentials. And they just got a really big one.
They did. CMMC Level 2 certification. That's the cybersecurity maturity model certification.
So why is that so important?
It's basically a passport. It's a rigorous security clearance from the Department of Defense. Without it, you can't even bid on contracts that handle sensitive information.
So this opens up a whole new world of high-value business for them.
A whole new world. This certification lets them compete for work in the C6ISR community.
And just remind us what C6ISR is again. It's a mouthful.
It is. Command, control, communications, computers, cyber, combat systems, intelligence, surveillance, and reconnaissance. This is not staffing. This is high-end critical defense tech.
And we're already seeing them win this kind of work. They mentioned a new contract with the National Institutes of Health.
Right, for cloud security migration using AI. This is exactly the kind of revenue they need to replace the Head Start and CMOP work that's going away.
Okay, so we have a clear strategy, some cool proprietary tech, a de-risked balance sheet, but still a near-term revenue problem, and no formal guidance for fiscal 26.
And that's where the market's skepticism is coming from.
The CEO did make a strong promise, though. He said they're confident they will soon return to low double-digit organic growth. That's a bold claim after a 16% drop.
It's very bold. And that promise hinges entirely on their ability to convert their pipeline.
Which is still pretty big, right?
It's robust, north of $3 billion, covering more than 24 months. And they see a lot of opportunities coming from the Department of Defense and military support, which seem to be hot areas right now.
So for an investor, it all comes down to timing. When does that $3 billion pipeline turn into actual awards and revenue? Yeah. Soon can mean a lot of different things.
It can. And right now, the market is pricing in the fear that soon is a lot further away than management thinks.
All right, this brings us to our next segment. This is not financial advice. This is purely for entertainment and discussion based on the data we've just talked about. Don't use this as a basis for any investment decisions.
Okay, so if you look at that price action, the 3.4% drop, you see a market that is totally obsessed with the temporary revenue problem.
That Head Start and CMOP revenue that was guaranteed to go away. It's pure transition fear.
Right. And at the same time, it seems to be ignoring the permanent structural improvements, the strong balance sheet, the cash flow, the pivot into that CMMC certified AI and cyber work.
So the divergence is pretty stark.
It is. So the outrageous but plausible idea here is what you'd call a pain trade long position. You're basically betting that the market's timeline is wrong.
So you buy the stock, and then what?
You combine that with a long-dated, out-of-the-money call option, say A one-year call that expires late in calendar 2026.
So you're buying the stock at what feels like maximum fear, and the option gives you the leverage to capture the upside if that growth comes back faster than expected.
That's the idea. You're betting on management's ability to execute on that $3 billion pipeline. The current price reflects deep skepticism. This could be an attractive entry for a patient investor who believes tools like DLH Cyclone are the real deal.
So the whole thesis really hinges on patience and a belief in management's execution.
It does.
This has been a really compelling deep dive into DLH. The key takeaway for me is that dramatic divergence we keep talking about. Cash flow and balance sheet strength on one side.
And weak revenue and a shrinking backlog on the other. It's a classic turnaround story, a company transforming its portfolio right in front of us.
So to wrap it all up, what's the final thought we should leave our listeners with?
I think the most provocative thought is this. We know they've cleared all their mandatory debt payments a year ahead of schedule. That creates a lot of flexibility.
Capital optionality.
Exactly. So how much quicker could they reallocate that money they don't have to spend on debt service anymore? Could they plow it back into R&D for tools like Cyclone, hire more engineers, and actually accelerate that return to double-digit growth?
Potentially compressing the timeline that the market is so worried about.
And maybe creating that short-term opportunity the market is currently missing. That's the billion-dollar question.
A great note to end on. The real test for this management team starts right now. Thank you for joining us for the deep dive.
Always a pleasure.